Welcome, everyone. I'm Angelo Robles to Angelo Robles' Effective Family Office podcast, where I look to distill the best practices and best ideas of the world's most successful families and their family offices. I hope to provide thought-provoking opinions and feature amazing thought leaders to our listeners of the podcast with an eye towards the future of the family office. Today's podcast, why the cannabis industry is poised to thrive. We have three special participants today: Ryan ANSIN, generational family member and co-founder of Revolutionary Clinics; CODIE SANCHEZ, founder of Entourage Effect Capital; and Morgan PAXHIA, co-founder of Poised Partners. We're going to be doing this podcast a little differently, and I've been looking forward to this for a long time. You guys are, luckily for you, going to get to hear, for the most part, a different voice. And Ryan ANSIN is going to take the lead since he is truly one of the world thought leaders about the subject. It's great to have him on and have him take the lead in today's podcast. A little bit of context about that. I've known Ryan for about 7 or 8 years now. And at one time, I was very fortunate to have him as the president of Family Office Association, my organization, and he did an amazing job and is very thoughtful, very studious, a hard worker, and now a highly successful entrepreneur, and still so young, still easily a millennial. I'm a little jealous, but it's great to have Ryan. I'm going to allow him to give some context in terms of the session, the speakers, and get right to it. Ryan, why don't I kick it off to you?
Thank you, Angelo. Nice to be back with FOA. It's been a while. And related to my millennial nature, I generally don't hire millennials, so we'll have to avoid that expression as much as possible. So I find most of these sessions to be a big waste of time. And so I'm going to try to frame this, and I'll be a bit strict with CODIE and Morgan, so that we can dive in quickly and leave you as a group, about 100 folks, with really actionable ways to approach, or if what you learned today makes you avoid the industry, do so with confidence either way. So the goals are, we're going to give brief introductions. I'm a huge fan of both Morgan and CODIE and what they've built. We're going to give a little overview of today's cannabis outlook, especially relative to the COVID pandemic. We're going to look at where cannabis falls in the small to mid-sized family office asset allocation, which is rarely done. I think most of these types of conversations assume that everybody has no other options, and that couldn't be furthest from the case. This is just one alternative, and there's a lot of optionality and a lot of space given the reset that COVID has hit on so many other sectors and industries. And finally, we're going to end up seeing if this asset class is worth the trouble. And we're going to do all that in a pretty short time frame so that everyone can get back to their regular scheduled work. So very, very briefly, this is really a conversation about the industry, and I'm thrilled to have CODIE and Morgan on. I'll give you my background so that you can have a litmus test on what I'm asking and saying. I've been investing in the space for the last 5 years or a bit more. I've been exclusively spending my time in the industry, definitely for the last 4 years. I'm an LP of 2 funds. I have 16 holdings in the space directly. And I advise both a debt fund specific to liftable infrastructure, and then a private equity fund out of Asia. CODIE, welcome.
Thank you for having me.
And I'd love to have a brief background so we can dive in.
Sure. So I'm part of Entourage Effect Capital. We're we sort of call ourselves a hybrid between private equity and venture capital, which is where the cannabis industry tends to sit. We have about 65 investments in the space and right around $200 million in assets. I myself come from an investment background, so the likes of iBanking at Goldman and asset management at State Street, Vanguard, and have always had a focus on emerging markets. I see this as another version of emerging markets, maybe in a new asset class they're in.
Thank you very much. Morgan, where are you sailing in from?
I was anchored off of Paradise Cove this weekend. It was a beautiful weekend here in San Francisco.
Wonderful, wonderful. Brief background, Morgan.
Thank you. Yeah, so quick story or background on Poseidon. Emily and I founded the company back in 2013. She's my sister, co-founder. So we've been investing in the industry since. We have two funds. Our first fund dating back to launching alongside of the opening of Colorado. And generated some pretty strong returns over that time. I think together between our two funds and co-invest, about 150 million in assets under management, returned over 20 million back to LPs. So very active in a lot of different areas across the US. We were early in Canada, exited when things got a little bit too crazy up there. Have investments in Mexico and South America and into Europe. So quite a diversified approach to the industry, but we tend to be more favored here in the United States. And I know we'll get more into that, but even though we've been doing this for 7 years, in our 7th year of actually managing money in this industry, still very early days, and excited about this next wave that's starting to take shape. Thank you.
Really appreciate having both of you here. So tell us today, in the wake of COVID, or in the eye of the hurricane, probably more apt if we look back in history a few years out from now. Tell us, what are the differences between cannabis investing today compared to 5 years ago?
Sure, I can kick it off.
No,
go
we'll
ahead,
start
Morgan.
with Codie. Absolutely not.
I know you're such a gentleman, always ladies first, Ryan. We've been doing this since 2014. I was actually an LP, similar to you, Ryan. I was an LP in this fund family in 2014 at a time when I would have been very concerned to go public into cannabis. We ran really large multi-billion-dollar businesses in the asset management world, and it seemed scary to go into the cannabis landscape, and we were uncertain what would be the ramifications across the board. What's fascinating is you fast forward from those days to today, and I think we've seen an acceleration the likes of which none of us anticipated due to COVID-19. If before COVID-19 you asked me or our team when legalization would happen, I think we would have probably said we still have another 5 to 7, maybe even 10 years to have the slow state by state movement, to really have FDA guidelines across the board. People were a bit too optimistic, in my opinion, about what our timeline was. Today, that is different. We are now listed as an essential service. And I think if history be our guide, we've seen that when there is massive economic turmoil and a need for employment and taxation, the government tries to increase its asset base. And one of the quickest ways to do that may in fact be cannabis. So I think for investors, the interesting part is we've moved from illegal to essential at warp speed, and that perhaps we see legalization. I think the risk there is we legalize faster than we anticipate, and not we have a longer legalization period than we think.
Morgan?
Right now, so from where we were to where we are today is, I'd say back then it was a pro forma, and today we actually went fast forward into fundamental, and the capital crunch has forced that upon us. Our industry's always been tightly capitalized. We've had moments where there's been capital flowing in, but businesses have had to be sharp, but they've had to be very sharp the last 12 to 18 months with the lack of capital coming in. And so back in 14, 15, you're trying to talk about TAM, and people are like, when you're talking about this industry being 50 billion and so on and so on in the 2020s, people were just like, yeah. Like, it was hard for people to truly understand that this industry had significant addressable market. And so I'd say in the early days when we were talking to investors trying to talk about that, there was very few companies to actually point to that had meaningful traction at that time, because it was so early in the legalization. I think back then there was, maybe a dozen states with medical, and here we are today with 33 legal states, medical, and what, a dozen or so for adult use. Check me on that, gang. But much more clear path than it was back then. We have analyst coverage now, we have comparables, you have exits, you just have so many more measurable data points. We have data analytics. So when you're talking about looking into markets, you can actually understand what's happening. So it's just a very, very different landscape today. And from an investor's perspective, you can come in with a lot more information than back then, where it was a lot of just kind of hoping and believing and working on the policy side to really try to mitigate that risk as things were taking shape.
Yeah. So two follow-ups on that before I get to the kind of macro questions that I was going to ask. One is for CODIE, where public equities and private alike right now have been so beat up, and capital is even is flowing even less today than it was a year ago. How does one consider the startup world off of pro formas, which any startup world will be based on that, compared to buying things at a discount right now, amidst an environment where assurance is so critical as an investor?
Yeah, well, I think, the interesting part is, pre this sort of crisis, the theory around investing in cannabis was that we were distressed as an asset class due to the valuation reset we had in June of 2019. And so for those who don't know, if you were to look at the public stock chart, what Ryan's alluding to is prior to June 2019, it was really a speculator's share class in a lot of ways. We had a lot of hot money, retail money coming into the space and inflating asset prices with no focus on, to Morgan's point, fundamentals or a search for EBITDA positive businesses. I mean, you would have been searching for a while. And so what happened is in June 2019, we saw the stock market publicly in cannabis reset drastically. We're talking similar to 99 levels. So anywhere from 50 to 90% reset in public stock market prices. And, when that happened, then, the investment thesis surrounding cannabis is we have this industry that's growing by a 25% CAGR year over year. And we have a latent demand, to Morgan's point, of 50 billion when we're only a $20 billion market, because that includes the black market as well. And so, so the idea is you can buy companies at low valuations today, now, but they have a huge revenue potential and a huge growth potential. So very seldom do you get an opportunity to invest in that sort of arbitrage. The interesting part about today is now the whole world is quasi-distressed. I think public markets are still pretty expensive. But so to your point, Ryan, how do you decide if this is worth it from a opportunity risk perspective? And
specifically, is a startup worth it?
Yeah, well, we would say no, but that's our thesis. So we do late stage, so 20 million plus in revenue. So I would say no, if that's your question.
Perfect.
If you,
that's my question.
Okay, so no, you want to go later stage. But I do think the other interesting part that we're probably going to get to is the fact that you get to buy at rock bottom valuations with companies that have double-digit revenue growth and actual real revenue when most businesses are out of business.
For sure. I'm going to come back to that on public versus private questions. So Morgan, you were talking more about the total addressable market, the TAM of this industry, how we were perceiving it from a pro forma basis 5 years ago, in your case, 6, almost 7 years ago, starting with Emily, your sister. When investors on this call are approached with an opportunity during which they need to question the TAM, total addressable market, how do you today think about cannabis users coming from the illicit market into the licit market, into the light, from under the table to above the table, compared to an industry sector that's evolving from non-cannabis to cannabis? So I've often said that I approach this industry by looking at the whole industry as a pie and wondering what slice of what pie does this product resolve or solve for. So the sleep portion of the pie, cannabis, CBN, there's a cannabinoid called CBN that is great for sleep. What is that pulling from? That may not be pulling from the illicit market. That may be pulling from the pharmaceutical market. So can you talk a little bit about what you mean by the total addressable market and how that evolves in your thesis?
Yep. So the low-hanging fruit is certainly the pulling out the illicit market. Legalization, draining that decision of buying illegally versus legally in a legal tested licensed operator. so I think that alone unlocks so much of the growth that we're seeing, this 25%, compound, for years to come here. But every state's different. So this is what's so nuanced about cannabis, is because we are doing this state by state, because it's still federally illegal. So the states that are choosing to legalize are doing so regardless of the federal government's position on that. And frankly, we're okay with that for the most part. There's a couple of nuances of that. Obviously, the disproportionate effect on population of people getting put in jail for this, it's pretty well covered at this point. But then also, right alongside that is banking. We need to make this industry safer. But then when you start thinking about each state, then in totality you get to TAM. But each state can be very, very different. So take Massachusetts as a great example. Unfortunately, sorry, Ryan, your home state, but Governor Baker shut down retail sales during this pandemic, which was thankfully just reopened on Memorial Day to huge lines of people all over the state, which was exciting to see that people want access to it. But again, there was a period of time where people had to choose, if they didn't have cannabis, where were they getting it from? They only really had the choice of the illicit market. And so that's where I see a lot of low-hanging fruit. Longer term, we do see additional crossover from baby boomers are one of the largest growing segments, looking for alternative therapeutics for sleep, as you mentioned, CBN. And this is where data is so important, right? And that's why we love data for every single state that we're looking at, or even in countries now, to help drive that, and looking at the product mix, because that is an indicator of, are these new generation consumers, or are we still talking about the transitioning of the illicit consumer that's buying legally? And that's usually more of a price or form factor driven type decision. And so you can see that in more mature markets. Colorado probably has the lowest of the illicit market. And so now you're looking at more of the crossover from more of maybe the wellness cohort. Here in California, we are just scratching the surface on the illicit market because of the regulatory and tax dynamic was really poor. So there's a lot of work to be done there, and we're trying to do that. But there's a lot of growth to unlock here, just from that perspective alone. So sorry not to get too nuanced or too specific with dollar amounts, but just because there's still a lot of variables.
Yep, makes sense. So with that, how do you both consider the beat up public market, where we'd have more liquidity, compared to continuing to drive forward into privates that may or may not have their feet gravitationally pulled to the earth?
Sure. I mean, we're a private investor by focus, and I think there's a couple concerns I have for the public markets and cannabis in particular. Many of the publics went public too early. So these were quasi startups that essentially decided to go public because, to both of these gentlemen's point, there was no access to capital. So the number one concern I have with public equities is a lot of these companies should not in fact be public in cannabis. Now, we benefited and we all profited quite a lot from these companies going public early on, which is how we were able to return the tens of millions of dollars we all have and call it 2 or 3 year time periods from a fund perspective, which is not normal in PE or VC land, as all of you know. But I do not think that happens in the future. So that makes me nervous on one hand. On the other hand, there's very few public entities that are actually EBITDA positive. There's a lot of public entities that have been overloaded with bad debt and bad CapEx spending, and they've overspent. And then the last leg, I think, is cannabis is a non-correlated asset in the sense of the fact that I believe it's a recession-resistant asset class because it does have components of traditional vices like alcohol and tobacco, but simultaneously aspects of consumer staples and healthcare, which are all recession-resistant asset classes. But from a public equities perspective, it actually has a pretty decent correlation with the generalized stock market in periods of volatility. So I like private markets because these are startups. There is not a cannabis company out there that is a mature late stage company. They should still be private for the most part at this space, in my opinion. There's a few exceptions. And we want to capitalize on that long strategic capital. We want to be sort of we want to be patient investors in a world of anxious capital. And that, I think, is where you make your arbitrage.
Thank you. Morgan, anything to add there?
Yeah, I mean, actually pretty intrigued by the public markets now in cannabis. We've been managing, our first fund does both. It's a hybrid hedge fund. So we can play in both private and public markets. And we've done that entire life of Fund One. A year and a half ago, we took that exposure way down and have kept low until now. And now it's getting interesting again. We've had this massive correction. We did a whole white paper about this last fall called the Darwin phase, or the Poseidon Capital Alpha Wave, and talking about this Darwin phase, about this period of time where finally we would start to see some of the weaker, poorly run, bad management team like companies start falling out the bottom, and the stronger starting to break through the noise. It was a highly correlated area for cannabis, the public markets. But they're all intertwined. We've grown up with so many of these public companies and private companies from when we launched. And so, we know a lot of the history of a lot of those public companies. So it's very easy for us to just, stay away from, 90% of them are not worth anything. And unfortunately with cannabis, you don't really have a clearing mechanism. So they just kind of hang out there. There's some that are still trading out there that have pretty much, in a financial definition, worthless common stock, yet they still trade. And I know this does happen in OTC markets like Fannie and Freddie. You can still trade their common stock, but does it have any value? No, but people trade it. So I think it's very interesting to be able to play on both sides and understanding that, because valuations are, there's a correlation between the two. Certainly when public equities were very high in our industry, it was pulling up private valuations. And then, as the public markets have been falling, it's been helpful to readjust privates, but just not nearly to the same volatility. But they are still connected. And as an industry that is so fragmented, it's kind of natural for more public activity, because we just have less access to capital. And some of these businesses are CapEx heavy. And so that is a way of getting lower cost capital. Certainly the last couple of months, that wasn't working for them. And so you saw them levering up like crazy. And again, that's why I think some of these or the vast majority are destined to go nowhere other than, a footnote in history. And that's why we call this the Darwin phase.
Yep. Pause there for a second. So before we move on from private and publics, since CODIE doesn't invest in the public market unless there's a go public motion and they have to lean in or lean out. And CODIE, if you want to address my ambiguity, feel free. But Morgan, where you are focused as a hybrid hedge fund, how long do you think the 90 people on this call have to learn and decide to lean into a depressed asset class, publicly traded, that will either pan out or start to mature and go up from this unnatural event in 60 seconds or less?
Sure. The haves and the have-nots, we're starting to see this right now. So if you start following the space, you're seeing the ones that are in trouble or have done too much too fast. They're divesting assets. They're trying to just spin things off. The stronger are showing really strong top line growth numbers, strong EBITDA, trajectories. And so, you're getting that bifurcation, which is great. And, but I don't know how much time we have, because one of the things that could kind of throw a monkey in the wrench in cannabis. So one thing we say is the only constant is change in cannabis. And so right now there is stimulus bill number 3 that passed the House and is off to the Senate. And McConnell last night mentioned that we need another stimulus package. Well, guess what? In that package is the Safe Banking Act. And for cannabis, that would be transformational. And so right now where these public prices are depressed, we could see a reflation of a pretty significant degree. And so everything I'm saying would just throw that out the window. So even poorer companies would all of a sudden go up, a huge amount, because the retail money would just flock back in. So, a lot of work has been done to start cleaning things up, but that can get disrupted along the way.
Thank you very much. Last direct question on COVID before we move on from there and start to open up questions from other folks. What is a failure or oversight that you learned about the industry, about your portfolio construction, or anything material from one or two portfolio companies during this time? Let's start with you, CODIE.
Well, I think The biggest lesson I learned here is how quickly we can have regulatory change in this industry and the binary nature of that regulatory change. And it kind of goes back to my first point. We went, the regulators in San Francisco and the local government initially said that cannabis was not going to be part of the essential services group. And they changed that very rapidly due to industry lobbying. And that has allowed these cannabis companies to do something that I've never seen before, which is, we are distressed and turnaround experts. So this is sort of the market that we were waiting to happen in cannabis. We want to put sort of unfair terms, debt-like terms on equity-like upside. And I've never seen a turnaround market before where you can have such low valuations with such growth and revenue potential. And because of the liquidity constrained nature of the environment, you can actually do these debt-like structures on top of them with real revenue in a company that has product market fit. It's just, I've never seen it before. I'm sure there's been other industries that have seen this. And so the biggest thing I worry about is, what if we legalize too fast? And to both of your points, how much time do we have to actually capitalize? We'll all make interesting returns, I believe, if we're in the space. But if I have another 3 years to do this, I think we do a lot more than if we only have another 12 to 24 months. So that's the biggest risk I see.
Quick follow-up. Because of the illiquidity in this industry, folks have gotten creative about how to attract capital since day one. Not-for-profit structures, draconian debt, all of this stuff that has just folded on top of each other. And now that the whole industry, other than a few public companies that got $100 to $200 million debt, which I have often trouble wrapping my head around anyways, even for those companies, people are in great need right now, and their cap table is already stretched so thin, and people are quite tired, and the entrepreneurs are tired. If you're taking this opportunistic stand, which I know you can do with grace, but help our 90 folks here understand how to keep founders or leading entrepreneurs in their company really interested when folks thought they were going to exit for $1 billion, and now their company's worth $5 million because they didn't catch up for cash enough.
I do think we're going to actually see a lot of public companies go private. So I think we're going to see there's going to be a lot of eating of the industry, actually, I think. And so the main thing may be that the best founders in the space will continue, and they'll readjust their equity pool so that they have a bigger equity percentage. And smart investors behind them will want them to succeed. But I think what's going to increasingly happen is that the best management teams probably come from outside of the industry or from those top companies that Morgan alluded to, and they eat up the smaller ones. And so we have already seen some public companies that are doing some private companies that are going to eat up some public companies and take their assets. And so I think the bigger question is, do we have the right founders in the right seats, or do we not, and we have some good assets and we need to get better management teams in place? And I think there's a few incredible management teams, and then I think there's quite a lot of people that need a little bit more professionalized management.
It's been fun navigating one or two of those with you.
I know. Yeah, you can allude to that, I think.
Yeah, for sure.
And Morgan,
as an individual,
we've all three been in deals together.
For sure. As an individual, I'll tell you what I've learned the most from this experience is I wish that I had been more focused on a smaller number of companies from a check writing standpoint as an individual, because I chose to spend, I chose and continue to choose to spend 8 to 10 hours a day on the operating company that I co-founded, that I didn't join a fund that has greater bandwidth to be able to manage, in your case, 60 plus companies during a time of downward pressure. And that's a lesson for all of us on the call. It's easy to sign a check in. It's very difficult to get it out during a downside scenario. Yeah. So Morgan, a lesson that you've learned before we speed up and move on.
Yeah, I mean, it certainly is being talked about a lot now. There's kind of like a buzz around distressed investing in cannabis. It's a buzzword for sure. It's messy. Not having federal bankruptcy protections, it's just, there's a lot of debt that follows along. It makes it really hard for an acquirer. So there's just even a lot of friction in that system. So, when the optimism in us will fight to no end to try to make things work. And that's good, but I think we've been lucky, honestly, in some of the things that we've had to do. And, Entourage and us together lockstep in a situation, and thankfully, coming out the other side, but I wouldn't do it again. So that's the lesson learned of like the amount of mental and emotional energy required and still managing through. Much rather would focus on businesses that are clean and growing, strong management, pay a higher valuation if need be, but just taking that risk down of that downside that is really nasty. Because another part of that is being a board member in cannabis. You got to think very seriously about it. And, a little bit plug about funds. I mean, that's like why we do it and why we pay a ridiculous insurance premium to have D&O coverage at our firm level, is because there is real risk. And so, as family offices and thinking about these things, there's a lot to learn in cannabis, and there's a lot to manage with a lot of companies, but having more than one shot in this industry is also very important. And so, anyway.
Yeah, thank you. So let's paint a couple pictures. I'd like to hypothesize a $50 million pool of assets, from the small family office or wealth holder perspective, a 200 and money is no issue. So 50 million, 200 million, and billions. You can either run through quickly how you'd position each of those types of families, or if you have a particular expertise or have been through the course a number of times with one of those three categories, I'd be really interested in how each of you see the portfolio construction from a percentage basis. And the last caveat I'll give is you can either do this from a percentage of alts or alternative assets, or you can do it as an overall portfolio. Where does marijuana fall?
Sure. Yeah, I can kick it off. So if the average family office has anywhere from a 25 to 40% allocation to alternatives, which is about, there seems to be no average in family offices, huge variance. So excuse the law of averages here, but so if that's the normal allocation, and then we see, private equity, let's call, both of us somewhere between private equity, venture, and Morgan, feel free to recategorize if you think you're more like, hedge funds, but typically the biggest allocation, right, in alternatives below real estate is private equity. And so if that's, somewhere like a 19% allocation, I think that, cannabis is another asset class in there that would be similar to your allocation that you would do to one of four industries. And I think that's, you've got to look at healthcare. So what's your healthcare allocation? And I think a lot of people put cannabis into healthcare component. The other one that we see people compare cannabis to is consumer packaged goods. So they put it into a sector specific like that. And then, and normally I haven't found very many family offices have a vice pool. That doesn't seem to be normalized. It's normally one-off situations. But if you have sort of a recession resistant nature, then we might go in there. I read a great UBS study a while ago about family offices that, all of you, 55% of you saw some sort of major recession coming in 2020. And so, 40% of you started to mitigate on the downside. And so that's how I think about cannabis. We talk about all these risks we have and what a nightmare it is to be a fund manager. It is a very difficult asset class, but there is a downside mitigation from the fact that we continue to sell at record high levels during this downturn. Yeah. So that's how I would think about it. And then you have to think about, a lot of people ask us, well, do we think about you when we asset allocate as a special situations fund? Do we think about which would be distressed, or do we think about you as growth or venture? that's where it gets tricky. And I'd be fascinated, Ryan, you probably have unique insight into this, but we have investors that are family offices and RIAs that put us in all three buckets. So some say we're venture, some say we're PE, some say that we're special situations. And so it really seems to be, what do people prefer, as opposed to a hard and fast rule that this is where the asset allocation may fall. But I don't see us ever being more than 1% of anybody's asset allocation. Somebody the other day said 10%. I thought that was probably for somebody who knows the industry really well. Typically we see people start at 1% and then maybe they tipper up as they like the asset class to something like 5.
Yeah, I also think that it's kind of an interesting conundrum, because if you were in early 2014, 2015, 2016, namely not 2017 or 18 or 19, because that's been a rough time period to initiate into the industry. But if you were in early, you have paper gains, if not realized gains, really through the roof right now. And yet most of them are illiquid. Even the public stocks, Tilray and Acreage, some of these are still locked up and they keep pulling strings and making tricks that they don't liquidate. So from a balance sheet perspective, it is a really interesting problem to try to solve. If you started at 1%, but that was 5 years ago, and now it has become 4%, 5%, and you don't want it there, how do you rebalance? And that's a hypothetical question, but an interesting one for sure. Morgan, thoughts?
Yeah, no, it's a fantastic question when that happens, because we've had some Fund 1 investors that have had that exact problem where we've become to a disproportionate size. That's part of why we did the big distribution we did at the start of 2019, was just to get a bunch of capital back to folks. When people try to put cannabis in a box, right? Is this alts? Is this, is this vice? Is this healthcare? To your point, and so this is a question I've struggled with and how best to answer. The way I think about it really is this is growth. Even though our Fund 1's a hedge fund, it's a long only growth strategy for the most part. I mean, shorting in our industry is a very risky proposition. People have gotten destroyed doing it. And so, we've done it very, very little. Second fund is a venture capital fund. Again, this is growth. So from our perspective, these are small companies, these are growth. And we're not just in any one, we are diversified. So we think of ourselves in a small growth category as a means of, if you have to try to confine us somehow, because that still gives enough freedom within that category to be in a vertically integrated operator or a SaaS-based technology company, but still confined in that growth bucket. As far as percentages, from what I've seen across our investor base, which we have about 150 LPs across our two funds, lowest amount I've seen is definitely a dip the toe in the water of 0.1% of assets to 3 or 4%. So I've seen, that, and that's been about the range. Maybe 1% is probably the most common number I've seen.
Okay. Thank you. That's really helpful. I don't think I've ever seen anyone ask or answer that question. Looking at the data set that both of you have, that's really meaningful. I appreciate it. So for the naysayers, which I think we all have moments where we feel like a naysayer, because this is an industry of getting a lot of gut punches. I often wonder, so I've had a thesis for a long time that I'd love to buy a nutraceutical company at typical price, at a typical private equity-like transaction, so a multiple of EBITDA. And then I'd like to take all of their products and start putting cannabinoids into them, vitamin C plus this, melatonin plus CBN, etc. Add maca root, which is a virility herb from Peru, into anything and mark it up. I have a friend that has 72% margins just going from wholesale to retail. And almost none of those things are governed or categorized in such a complex way as THC. Some other day we can have a longer conversation about CBD and everything else that will fall under it. But at the end of the day, right now, where you can buy blue chip stocks at a discount, with coupons, with 30-year dividend track records, north of 5% coupons or tickets. is this worth it? And if it is, which I think we all agree that it is, if it is worth continuing to put fresh capital in, if I may ask, what percentage of your portfolios are in cannabis?
Well,
Go ahead, please, Martin. Yeah.
It's an easy answer for me because it's about 99% of my net worth is in. I'm all in, but that's because, you know, we started the firm, Emily and I, we started with what we could. And so, you know, we're invested both in both funds. And so I've certainly, you know, had a disproportionate amount of my net worth has now become cannabis. And I know that's not going to be for everybody's sake. And eventually I will diversify that away. But for now, I still see an incredible amount of growth. And, you know, before this, I was thinking about, I've been talking about cannabis in the state of the US economy is there's kind of like a barbell economy right now. You have FANGs and you have cannabis. And unfortunately, there's a whole lot in between. But these are two big growth areas, right? But if you look at the valuations to the FANGs, just to some cannabis names, you know, we're trading cheaper than FANGs. And so that's actually really interesting.
How much cheaper? Because we're at a historic price to earning ratio. We're at a historic PE ratio time right now. That's totally irrational. So to what discount is cannabis trading?
Yeah, so I mean, price to sales across like Google, Apple, Amazon, Microsoft, you know, it's around probably just weighting them probably north of 6, and EBITDA is probably almost 20 EV to EBITDA. Okay, and quarter over quarter, you know, on a year, so Q1 to Q1 from 19 to 20, we're talking low double digits growth. Okay, and so if you compare to that to just like GTI, which we were longtime investors early with them, they're trading at 4 times and 16 EV to EBITDA, and they're growing at 267%, you know, Q1 to Q1. So completely different growth, like true growth, versus like FANGs are becoming less about growth at this point. You know, it's like iterative kind of things. We're still in true growth. And like, I'll tell you, even like employees that have come out of tech and come to cannabis, like this is what tech was like 10 years ago, where we had real growth.
Thank you. Cody?
Yeah, I mean, I would say about 70% of my wealth is invested in cannabis. Like I said, I ran a couple of large asset management firms prior, so I have a lot of stock locked up in emerging markets and some other businesses and real estate. But our partners, we have, I would say, across the board. And you know, my partners ran really large business. I mean, Andy was a tech. He created one of the founders of Movie Phone and Sportsline. And Dove sold a couple businesses, you know, for hundreds of millions of dollars. And, you know, Tiffany comes from Sun Capital, where her husband's the CEO of Sun Capital. So, you know, they had all done really well previously. I'm probably the youngest and had done okay for myself, but I certainly wasn't at their level. But what I can say is all of us have our largest asset allocation in cannabis, not because this is the first time we made sort of quasi-generational wealth, but by a choice. And the reason, you know, I think that we continue to do it is even more apparent right now. Like I looked back at 2008, and 2008 was a real estate crisis, right? So if you would have done one thing different in 2008 to 2009, 10, 11 till now, it would have probably been buy real estate. I think 2020 is a small business crisis. And I think the one thing that we are going to wish that we had done more of through this is that we have accumulated more revenue producing on path to profitable small businesses, because they are at such a discounted level. And we see this in cannabis as well. And so even if we take just the cannabis lens off, I like the small business and startup lens that we have on top of it as well. I think it's an interesting, really phenomenon and point in the market and trigger. The thing that I think is the main differentiator is, you know, the fact that we have an industry that already has this latent demand. I see it very similar to 99, except in 99, you know, consumption of the internet went up, you know, by 200% over a 3-year period. But you didn't have internet users before. You had to create the market. This is one of the first markets in which you already have users and you don't have to create it. So I really think the asset class has a huge amount of legs. But I do think, to all of your points, we're going to have to be very thoughtful in which companies we choose. And It's very hairy to do distressed deals, no doubt about it. We all three know this, and my partners are definitely even more schooled than I am with decades in the matter. But this is when you make your money. If you look at PE and VC vintages post-crisis, they are double-digit higher returning than during bull markets. And if you look at companies that do distressed and actually operate companies as opposed to pure VC, year over year, they have higher return profiles. So it's not a fun game, but that's why you pay managers, because, you know, family offices, you operate your family business and you don't want to have to operate, you know, you don't want to have to do what poor Ryan has to do every day, and us too, which is manage these growth businesses, whereas every startup is always on the verge of failure. And you have to, the only thing I would add is, from a tactical perspective, forget the funds. If you invest in cannabis at all, make sure you have massive oversight on the companies that you invest in. Any errors we've made have been when we didn't have full financial oversight, we didn't mandate control in varying situations and where they don't hit their milestones, and where we are not consistently communicating with them about every stage of their business. You cannot be a passive investor in cannabis, in my opinion.
Great points. I have a bunch of quick little questions that I'd like to ask, and then I'm going to push it over to Angelo, and if he wants to bring in questions from the audience.
Yes, and what I could do now, Ryan, so I could prompt that to start to happen. We have a significant live audience listening in. Please use the chat feature on Zoom. Don't take yourself off mute. Use the chat feature on Zoom, and 70% of you are coming in through the link, so you know how to do that. And feel free to submit a question. I'm not sure we're going to be able to get to all of them. We'll see how many come in, but I'll be able to see them. And when Ryan switches that over to me, I'll be able to articulate the question that you're asking. But now would be a good time. Thank you. Ryan, it's yours again.
And we'll try to get you out of here in 8 minutes so you can get to your 12 o'clock Pacific Standard lunch in your kitchen. My inbox, Cody and Morgan, is full of opportunities, they think, to invest in psychedelics, because I've been investing in cannabis. I assume yours is as well. Are you taking your eye off of cannabis and widening your lens?
I am not. I have no interest in the quote unquote mush rush. There's so much to be done here in cannabis. This is our dedicated focus. So yeah, I'm very intrigued by it. I'd be very happy about legalization, so I'm not against it. I'm just, from a focus perspective, staying focused.
Yep.
Yeah,
Cody?
we're the same. It's, you know, our investor mandate allows us to invest outside of cannabis, to allow for hemp and CBD as well. But we haven't made an allocation there. The only thing that I will say is, anytime there's a new parallel industry, we usually assign an analyst to do a dive on it. So, you know, we have an analyst who has the great job out of college of being able to dive deep into the world of mushrooms. What a bizarre world we live in. But it's not somewhere we're putting dollars at this time. I still have a hard time, Ryan, understanding in that space, how do you monetize if some of the things they say about mushrooms is that you have 1 or 2 usages and then you have, you know, sort of a cure. So we're not allocating there yet.
Time for another call, or subject for another call. I hope that analyst position is volunteer. Sounds fascinating. There's always, I've noticed in this industry, every quarter there's a new subject for the smartest person in the room to talk about. A year and a half, 2 years ago, it was that brands are going to dominate and brands are the only way to make money. Do brands really matter yet? And if they don't yet, when will they? What will the straw in the camel's back be that make that such an overwhelming area of returns? Start with you, Cody.
I do think brands are starting to matter. You know, this is an industry which has a lot of commoditization in it. It is called weed, after all. Thus, this is something that's supposed to grow pretty easily. So, you know, we are seeing the first sort of cannabis brands emerge. But what we don't have yet is we don't have real consumer loyalty, because nothing is national. So that will be the change, in my opinion, is we'll start to have brands really matter when brands can have some sort of aggregation around a few states. Right now, brands at the most the most prolific brands I've seen are in 10 states. That is really not enough to reach critical mass. However, if you have New York legalize and you have California legalize and you have a market like, let's say, Florida legalize, then you start to get cross-coastal brands in some kind of cool cities that can be sort of viral, for lack of a better word. And I can see brands actually becoming more important.
Yeah. Morgan?
I think more of a premium is on the strength of the operation than it is on the brand. If you're able to execute, just being able to deliver consistent products on a consistent basis will get you customers. And you know, in limited license markets, it's even easier because there's just limited access. But in competitive markets, like here in California, you can have the greatest brand in the world, but if you can't make it, it doesn't matter. And so that's really how shelf space is being won long term. I think here in California is a great example. Just being able to be a rock solid operator will get you there. And that brand will earn that brand loyalty just because you're there, and the consumers will, you know, and they have to be good products. But again, if you're a good operator, that is the real key right now.
Yep. Morgan, Trump or Biden, who's going to win, and who would you prefer, only considering cannabis, leaving everything else aside?
Good caveat. So that is, that's a great question. This, you know, going into this pandemic, I would have thought for sure we would have seen some progress. But the one thing I've always been thinking about is you don't have to pull the cannabis card yet. So we don't know where we'll net out. I mean, Biden has been pretty consistent that he still is not really in favor for it. He says more research has to be done, and so there's mountains of research at this point. So there's an education to him about it. I think from our perspective, it's really just if we can get the Safe Banking Act, I'm fine if the federal government doesn't want to do anything more than that for the next couple of years, next several years, because we still have a lot to learn from a regulatory standpoint. So I guess I'm more focused really on the Senate races and what that means for our industry, because there's a couple of key seats coming up that could be very meaningful for our industry.
CODIE?
I mean, I'll go ahead and throw out some names so we can, you know, leave people with something to talk about. I think Trump likely wins in this next upcoming race. We also had him predicted. My background is as a macroeconomist, so we had him predicted to win the first go round, which certainly didn't win us any friends in the beginning, but turned out to be true. So I think he probably wins, and if I had to choose between the two, I would, you know, the interesting part is I think we're better off by having states legalize, which is called the States Act, so allowing each state to legalize. I'm a little bit afraid of if the federal government legalizes broadly, that we will have some draconian measures on top of it, things like social equity sort of across the board. So I might be more behind somebody like Trump, who I think will allow the states to legalize continuously, but he's such a wild card that the uncertainty for the industry is really dangerous. So I suppose I would say Trump's likely to win. I think he'll be okay for the industry. I did not think that when he got first elected, but I'm with Morgan that they say that all politics is local. All cannabis is really local at this stage too.
Yep.
And so we are watching county by county, state by state, and Senate election by Senate election.
Thank you. I'm going to ask 2 questions that came in. There are 5 that came in, and I'm going to ask the 2 that I think will interest the largest portion of our audience, and I'll follow up with everybody else. And please, Morgan and CODIE, just choose one of these, and then I know you're both adept enough to choose the other. So Morgan, to you, either of these 2, which geographies and/or jurisdictions do you find to be currently most interesting? And that includes a consideration of Latin America or Europe. Question 2, option 2 is, can you give us a few common characteristics for success that you've distilled from your portfolio companies? And thank you everybody for these questions.
Yes, so I'll take the first question because we made a big investment in Mexico that we started work on about a year ago, closed in September of last year. And that's controversial. You know, there's definitely some people that think we're a bit out there for doing it. But You look at the demographics. It makes Canada look like, tiny. So we're very bullish on it. It's taken longer. COVID certainly did not help us in that timeline for legalization, but our work down there is still pointing towards legalization, and that's a very interesting market. And we specifically went with pharmaceutical grade manufacturing as the way to open up that market, because it not only serves that domestic market, but it can also be a footprint for low cost global distribution.
Thank you very much. CODIE?
So the second question was about characteristics and skills and traits in founders that win, essentially. Yes?
In companies that win, not necessarily founders that win.
Oh yeah. Okay, great. So a couple, I suppose there's two lenses. So if you're putting on the lens of investing as an entity that's going to do public investing, let's say in public stocks, I think you should have one singular focus almost, which is, are they on a path to profitability? Do you believe that path to profitability, and are they almost EBITDA positive, if not already? And everything else is noise at this point, in my opinion, in the public markets. From a private investor, the companies that I want are companies where they are already having meaningful revenue. So we're talking at least 20 million, getting up to 30, 40, $50 million in revenue, but where we believe that they have some sort of platform ability for us to do add-ons to. Okay. And so our thesis is really that once cannabis legalizes, we're going to see acquisitions come in from external industries, but they're not going to acquire companies that are sub $20 million. And they're really probably not going to acquire companies sub $100 million in revenue. So it's a little bit of a race to profitable scale. And so we're looking for companies that have real product market fit, that have actual revenue, that don't have outblown valuations, and that have, in our belief, an ability to grow further. That means probably limited license states and not things like cultivation. We don't want pure cultivation plays. And we want them to be able to capture some of the margin. So ideally have manufacturing or brand on top of their cultivation characteristics.
Thank you very much. I'm honored that almost everybody stayed with us for the whole hour. Really a testament to you, CODIE and Morgan, and appreciate everyone for being along. I know all three of us and Angelo are here to be helpful if we ever can be. Thank you, everybody. Angelo, to close.
Yes, and actually I'll give a couple of seconds to thank all of you. And if you all could note, from Ryan to CODIE to Morgan, you did a great job. In a couple of seconds each, how could people learn more about your organizations? Ryan, I'll start with you.
Sure. I'm very easily searchable, dangerously so. You're always welcome to reach out as it relates to general direct investing in the industry, impact investing relative to the industry, or if you want to learn more about revolutionary clinics here in Massachusetts. We're very weathered.
Great. CODIE?
Probably best to find me at entourageeffectcapital.com. We're also very active on LinkedIn. So I'm just CODIE SANCHEZ there. And look forward to hearing from all of you. Happy to answer any questions I can.
Thank you. And Morgan?
Yep, our website, Poseidon.partners. Twitter is at Poseidon Asset, and also on LinkedIn as well. Yeah, we're out there in the social world.
Excellent. And as many of my members know, I do have to give a relatively probably a little bit too long of a close, but we have so many new listeners coming into the podcast as this gets released. And my goal one day, like Rogan, Spotify may want to pay some attention. We have excellent growth, which again has been intriguing during COVID. It's been a great time for podcasting. So I'd like to again thank Ryan, CODIE, and Morgan. That was really a fantastic session. Ryan did an amazing job in leading it, and you were all wonderful participants in it. So I appreciate your time and certainly look forward to a next one. Everyone, I'm Angelo Robles. I'm the host of Angelo Robles' Effective Family Office podcast and the founder and CEO at Family Office Association. We're a global membership organization dedicated to families of great success and their single family offices. We do a tremendous amount of original, creative, and proprietary content, from videos to our meetings, our podcasting, our writing, our social media, and we host events. Now, I would have said 2.5 months ago, lots of physical events around the world, which is true, and we've had some of the most amazing speakers. We've been very fortunate. And one day that will come back. But in the meantime, we've adapted. Monday through Friday, with the exception of holidays, we host, like we're doing today, daily online meetings. We're incredibly active, and we've had great guests, including, of course, today's wonderful guests, but people like Jeremy Grantham at GMO and a great philanthropist on climate change, to the UN and the WHO coming up this Friday, to people like Anthony Scaramucci, Adam Robinson, and many others. We've been very fortunate. So the online meetings have been fantastic. It's been a wonderful opportunity, really much easier globally for our community to connect than needing to fly in with the expense and travel to the usual suspects, New York, Miami, San Francisco, LA, etc. We also do a significant amount of opportunities of peer-to-peer, our members to connect from that perspective. We have various portals for our families 24/7 anywhere in the world. So there's many benefits. I'm not even going to get into the consultative side, which I've done in some other podcasts because we're a little tight for time today. But I encourage you to reach out. I'm extremely active on social media, LinkedIn, Angelo Robles, as well as Family Office Association on Instagram. And I definitely recommend, because this will be up on there in a couple of more days as well, we have a very much growing YouTube channel, and that simply is Family Office. So very easy. I could be reached at familyofficeassociation.com, angelorobles.com, and preferred email, angelo@familyofficeassociation.com. Thank you all for our live participants. Those that hear this in a podcast and video, thank you very much. And again, would like to thank our participants today, Ryan, Cody, and Morgan. All did a great job. Everyone have a great day. Thank you for your time.